All right, guys, good afternoon. My name's Ryan Yaple, for those of you who don't know me. I'm from Ann Arbor, Michigan. I've been selling on Amazon for about 4 years. In September, it will be. Uh, Grown 350% over the last year. We've done about 170,000 units in sales so far this year. So this session is going to be about knowing your numbers, something that I'm very passionate about, something that I know a lot about. I also worked a little bit in the tax and accounting industry before I got into Amazon. So I'll pass it off to Dang here to do his intro.
Hello? Awesome. Greetings, guys. My name is Dong Lee. I'm primarily an arbitrage seller. Been doing it a little over 2 years. Did close to $1 million first year, a little under $2 million second year. We'll see what happens third year. My background is primarily investments, finance, and poker. And so I bring a unique perspective as far as knowing your numbers.
So a little bit of what I'm going to say actually came from last year at this conference when Robin Johnson was speaking. She had a session similar to this where it was really important about knowing your numbers. And something she said still sticks with me a lot. She asked during the session that we had probably 100 people in the room or so, how many people know what their break-even number is every month? So that's the number that you have to profit in order to cover your fixed expenses. So fixed expenses are things like your rent, your subscriptions to like things like tactical arbitrage, inventory lab, things of that sort. Things that you have every single month and they're the same amount. You also have variable expenses, but since those can fluctuate, things like your electric bill if you own a building, or maybe you use something like scan power where it's usage based, so it goes up and down, it's a little harder to predict. There was very few people that were interested in knowing their break-even number or even finishing the worksheet, which is a little disappointing to me, because if you don't know how much money you need to make every month in order to just pay the business to stay in business, you might go out of business very quickly. So it's really a simple formula of going through and looking at all the things that are recurring out of your bank account or recurring off of your credit cards that are fixed expenses every month, adding those all up, and then looking at what your profit is from somebody like your accountant or out of a report out of QuickBooks if you do your accounting yourself. It's really, really important to know though, because it'll tell you whether you can continue expanding if you have money to spend on other things, or if you need to focus on moving more product, getting rid of stale product, doing something else to move your business forward. So that's one of my biggest things. We also do a lot about knowing your numbers on an individual item basis. So if you see something that's not moving, you need to figure out why it's not moving, whether you need to run an ad campaign, whether you need to go through and adjust your price, whether the buy box is suppressed, there's a problem with the listing. There's a lot more to knowing your numbers than just looking at numbers on a spreadsheet or in an accounting software. I'll pass it back to Dang. We'll probably do a Q&A session, but that was my biggest point I want to get across and what can really help you grow your business.
My biggest pet peeve is how many of us have seen on Facebook, usually a beginner will post, I did 30,000 sales, 50,000 sales, 100,000 sales, whatever. And what is the number one response that people give? What's the profit, right? They're like, always, what's the profit? But the profit is not even the end of the conversation, or even, it's the beginning of the conversation. Because I could ask you, if you reported $1 million of net income last year, would that be a good thing or a bad thing? I'd say for most of us, it would be a good thing. But if you're Bill Gates, it's a shitty thing, because you have a very poor return on equity, even though your net income is high. $1 million on an $80 billion asset base is very poor. He can make $1 billion plus by just putting his money in a bank account. So you want to look at your net income, but the return on equity is a measure that tells you how quickly over the course of a year your entire bankroll is growing. And so one of the most beautiful formulas in all of finance is the DuPont ROE decomposition. And to break it down, it's your income divided by sales. That's basically your profit margin multiplied by your sales per asset. That's your asset turnover multiplied by your assets per equity, which is your leverage ratio. So by playing with any of those three levers, you can increase how quickly you're growing your entire capital base. You can either source products with higher profit margins, you can source products that turn over more quickly, or you can increase the amount of borrowing you use in your business. So that's one thing that I've been on a mission to sort of push, that you're not looking at just the ROI of a single sale, but you're looking at the blended ROI over time of the entire portfolio of products.
Awesome. But like I said, he has background in finance. I have a background in tax and accounting. I worked for Thomson Reuters, which owns Reuters News, but we also owned a tax and accounting business unit and make software for CPAs. So I was helping CPAs do 1120, so corporate tax returns, S-corp returns, personal returns, things like that. I'm not an accountant. I'm not a lawyer. I won't pretend to be, but if you guys have questions that are more general or about really anything, go for it. We have tons of time, I think, about another 20 minutes or so. Hi, Chris.
No, it's just other concepts that I thought were useful. I haven't really heard people discuss as much. One concept that I really like is the concept of a payback period or a payback percentage. So let's consider scenario A. You're sourcing a product for 20, selling for 100, you're netting 80. So basically, you're getting an 80% net payout for a $60 profit. And another scenario, you're paying 40, selling for 100, netting 80 for 100% ROI. In the case where you're sourcing for 40 with 100% ROI, you have to sell 50% of your products just to get your money back. But so, I mean, given that I'm coming from an investment and poker background, I always look at things as far as upside downside ratios. Like I can gain 10 and lose 1, then I would be all in on that product. Or if it's a 1 up, 1 down, I'd be more lukewarm. So if it's a situation where it's a 1 up, 1 down, 100% ROI, you have to sell 50% just to get your money back. But if it's a 4 up, 1 down, then you only have to sell through 25% of your product to get your money back. And in business, if you can set up situations where you're getting your money back with a high probability and very low holding periods, then everything else is gravy for you. And I guess to draw an example from my previous life, I was purchasing stock in this company, Footstar. They ran the shoe departments in Kmart's. And since they had just emerged from bankruptcy, they had no debt. It was newly issued equity, but they had about $5 of cash on hand, and the stock was selling for $4.25. And then you also had the inventory and the plant and equipment. So I purchased the stock. I went all in on it because the cash provides a floor for your investment as far as how much can you lose. So I bought all in my retirement account for $4.50 a share. 2 or 3 months later, they issued a $5 dividend. So by doing that, I no longer have any risk in my position. So looking at those situations where what's the upside downside ratio and how do I manipulate that in my favor? Like here's another example to illustrate. Let's say you're buying an asset for 50 and selling it for 100, or an asset for 25 and selling it for 100. In the first case, you're profiting 50. In the second case, you're profiting 75. That's per unit. But the thing you have to remind yourself is that you're never investing units, you're investing dollars. So if I have $1,000 to buy the units at 50, then I will be profiting 50 off of 25 units for a $1,000 profit. With the second case, if I'm buying at 25, I'm not just increasing my profit by 50%, it's actually 300%, because now I'm buying 40 units instead of 20 and making 75 per unit. So it's $3,000 total profit on the same decision. So it's not that you're profiting your profit goes from 50 to 75, but your profit goes from 1,000 to 3,000. So I'm always looking at those types of situations. It will allow you to travel easily between different business models if you're looking at everything as upside, downside, cash inflows, cash outflows on that type of schedule. It's like, okay, if there's anybody that's a powerful user or a heavy user of Excel, one of my favorite functions is XIRR. It will allow you to put in a schedule of cash flows, like in and out cash flows, as well as the date. So that will, if you invest $100 and at the end of the year you get $200, it's easy to calculate you got 100% ROI. But what if it's $100 and then you have to pony up an additional $10 every month, and then I pay you $300 at the end? What's the internal revenue or internal rate of return on that type of decision making?
It sort of also goes back to the other elephant that no one really likes to talk about is it's great if you can have $300,000 or $400,000 in inventory because, your sales should be great. You're doing so well. You have all this product at Amazon. All the buyers want to come buy from you. Except if you have $300,000 or $400,000 in inventory and 80% of it might have been there 6 months and hasn't sold more than 5 to 10% of it in the last 2 months, you have a whole different situation. So it's not even about knowing your profit all the time, although that's very important. Knowing your break even is very important. Knowing your rate of return and or return on equity is important. But it's about knowing all of these things in a bigger picture so you can make better decisions. Because if you have inventory, which truthfully in this business, cash is king. That's something that Peter Drucker said, but it's a business school term, still relevant to Amazon, 110%. If you don't have cash on hand to pay your bills when you need to pay it, and you have $300,000 in inventory, $250,000 of which you can't sell because no one wants to buy it, it can be a whole nother ball game, unfortunately. So it's important to look at everything as a whole, but it's also important to sometimes dive deep down and look at why things are the way they are and what you can do to fix it. Go for it. Oh, hold on just a second. He's going to run you a microphone.
To piggyback on that point, that is probably one of the scariest things for me, is the inventory that hasn't sold, because it's the dog that didn't bark in the night. It's because if you have a sale on it, you have visibility into the income, but that's the thing that doesn't show up on the income statement, is all of that unsold inventory. Projected to sell, but it might not ever sell. And if you're not being proactive about either writing it down or taking losses on it, then it could definitely build up over time. And you'll be like, okay, I'm rich on paper, but I can't afford to pay for dinner. And so you definitely don't want to get into that type of position where even if the income statement is healthy, because 20% of your stuff is moving, but the 80% is not moving. And so you're reporting income on the 20%, but the 80% is just going to drag you down over time, especially if it builds up.
Hi, to get your opinion, so I have a product that I sell about 60 a month. It's a 40% return, $40 profit, and I'm debating, should I lower that $20 so I'll get a 20% return, $20 profit, but will I turn more?
So with that being the question, let me ask you this. Do you have, just as a quick follow-up, do you have a lot of returns? Do people return it back and it becomes unsellable a lot?
No, it's I can continue replenish. I'm buying directly from the brand.
Okay.
I sell about 60 a month, and I'm thinking, well, how can I get to sell to 100? But I'm trying to keep my return 40%, $40 profit, just on that one product, and I'm debating.
So if you want to increase velocity, you can do one of a few things. Number one being looking at the listing, is if there's something you can do to add to the listing that would enhance it, whether the photo might not be very good or some of the photos are just not. I sell this pool cover that, and you can probably find it if you really go look for this on Amazon. It's literally taken in somebody's backyard. With this pool they had, there's an inflatable pool and the pool cover is on it. but it still sells really well. But to your point, like you said, I wouldn't try and cut margin if you can avoid it. Keep the margin that you have and look for ways to increase it. So improve the listing. Look to see if it makes sense to do potentially run a sponsored ads campaign. You could start with an auto campaign. There's much better people at explaining PPC than me, but you can start with an auto campaign, run it at maybe $10 a day for a week to see what sort of traffic you would get, and then sort of narrow it down from there to improve it. You can also go through and see if it makes sense. Not every product does, but it's something that people might buy multiples of. I sell a lot in the grocery category, so if you're going to buy one bag of candy, it might make sense for me to offer it in a 2 or 3 pack, where that way I can increase velocity overall with the brand or the product, but I'm not hurting myself on margin typically, or if I am on a 2 or 3 pack, it's not more than 5% usually. But different ways to do different things. I don't know if Dang had something to add to that.
I guess my input or question to you would be, what's the price elasticity or inelasticity of this product? Elasticity. Like, will a 5% change make a huge drive in volume or not?
No, actually, I started just raising it. I was selling it consistently at.
If they want it, they want it.
Yeah,
Like
no, they do. They want it.
I sell primarily shoes and clothing. If you offer me a size 12 shoe, even if it's a great deal, I'm not interested. But if there's something that I want, then I'm willing to pay up. And so
I went from 149, selling really well, to 159. I still continue seeing the sales. 169. I keep pushing it up. But I'm thinking, well, should I go to 179 or should I come lower? Might get more sales.
Well, what's the nature of the marketplace?
It's a
how many competitors?
I'm the only one.
How about competitive products?
It's a book.
Okay.
So it's.
But if it's the only book that answers that need.
Yeah.
So maybe increasing the price could be.
Yeah,
the
I keep
answer.
raising it. Sales keep coming, but I'm thinking if I lower it, will I get more sales?
So it's just a humble brag, basically.
No.
I don't know what to do with all this money I keep making.
I can help. I'll take some. Oh yeah, I think we can all redistribute a little bit of the wealth. It's all good.
So I think your answer, because basically it seems like if they see your product, they're purchasing it. So you just got to increase the number of eyeballs that access to your.
Advertising's the biggest answer there. If it's something people want, and you just need to get more people in front of it, sponsored ads. And like I said, there's a lot better people to talk to about that than me. Although we do well with sponsored ads on certain brands and certain products. But go ahead, Mr. Coolahan.
So, you guys are talking about 2 miles above my head most of the time.
Yeah, sorry.
No, it's cool. But just say I'm a pretty good size reseller, and I'm making money, but I've got this sense that my inventory is growing. Take it from the beginning. What are the kind of things if I'm going to start knowing my numbers, what are the kind of things I should start? What kind of baby steps can I take to start looking at the right numbers and improving them to make sure that I get the right sell-through rate, the right ratio to active and slow-moving products and that sort of thing?
Absolutely. So I think the best place to start for all of us, because we're in an inventory-based business, is the inventory health report. That will give you a very good idea of how long something has been in the Amazon warehouse system by ASIN, by SKU. It'll tell you 0 to 90, 90 to 180, 270 or 271 to 365, 365 plus. If you have things and it's more than like 1 or 2 of something that are going into the 91 to 180, that's the point where it becomes really important. If it's been there more than 2 or 3 months and it's not selling, that's really important to look at. It may be even more important sooner depending on the size of your inventory and what business model is. Because I do grocery and we buy such quantity, we look at it a lot more often on a per SKU basis because we only have depending on the time of year, 400 to 500 activations. So it's a little bit easier than somebody that might be doing books, for example, or doing shoes and clothing where you have maybe 4,000 or more activations. The other thing that you can do that's really easy is taking a look at and taking just a sheet of paper, could be notebook paper, it could be printer paper, it really doesn't matter, and writing down what you pay for every month. Looking at every single one of your credit card statements, your PayPal statement, and your bank statement, and saying, what am I actually paying for on a recurring basis? And do I actually use all of these things? I have had things I've paid for 3 or 4 months before that I'm like, I think I signed up for a trial with this company, but I've logged into it once and I just don't have time to look at it right now. If you can write down those things that you pay for a recurring basis, once again, those are your fixed expenses. It's just as simple as that. Those are the things you have to pay for every month, unless you're going to cancel them, like cancel a subscription or something like that. You have to pay for them. There's no way around it. But it's a good question. That's where I would start. A lot of it would come into, once you get to a certain point, I do know sellers that sell over $500,000 to $1 million that do their own accounting and books. It's perfectly fine if you guys want to do that. At that point, though, I would really recommend at least having an accountant review what you're doing or what a VA is doing every quarter at a minimum to make sure it's being done right. You know, we're all good at what we're good at, and sometimes bookkeeping isn't one of those things.
So you kind of answered my follow-up question.
Okay.
Are there numbers outside of inventory numbers that you would look at? Obviously, subscription is one.
Subscriptions is one. If you have rent or a lease or a warehouse space, that's another. Payroll would be another, but that can vary depending on time of year. If you have things like shoppers in an RA business, or if you have warehouse workers, that might work more in Q4 versus over the summer because you just don't have as much for them to do. That's sort of our position right now. Is summer's our slower time because we can't do chocolate. There's not really a lot of seasonal candy in July.
How often, this is for both of you, how often do you pull a cash flow statement and look at it? Is it like monthly, weekly, quarterly? Do you feel like looking at a cash flow statement is an important part of managing your business?
I look at it once a month. So I use a third-party accounting firm out of Tennessee called The Bottom Line, and they're really good. They actually do all my books for me, and they manage all of that. But I log in and I look at those statements every 2 weeks because they actually run through the accounts the week after my Amazon disbursement. So it makes a lot of sense. I can see what position we're at that point in time, but I'll let Dang answer.
I'm probably checking monthly, sometimes quarterly. But your original question, I don't think there's a right way to do it as far as what's the preferred business model. Although Amazon might have a preferred business model for us, but you can definitely do a lot of fast turns, lower ROI, or I tend to do low turn, higher ROI stuff. Assuming that in both scenarios, you're reducing the amount of dead or phantom inventory. So I think your original answer about looking at those reports is very useful. And then whether or not you want to just turn stuff 3, 4, 5, 10 times a year versus 2 or 3 times a year, but with much fatter margins, it's more personal preference.
So on the topic of dead inventory, when you're analyzing the ASIN or the SKU, and you're trying to figure out, okay, I want to optimize the listing, or I want to drop the price, or I'm going to run some PPCs. What are, for you two guys, I know it's going to be different for everybody because it's kind of a personal opinion, how long of a test period do you give it for those changes before you're going to decide, okay, I'm going to do something else to try and get it to sell?
Depending on the time of the year and depending on what other projects and or fires I'm putting out at that week, it might be once a week or it might be every 2 weeks. It sort of depends. It gets a lot more frequent when you get closer to long-term storage fees. And it also was a lot more frequent the last month for me personally because of, and probably for a lot of you as well, because of the free removals. We tend to carry a lot of inventory at Amazon. We had, as I looked, about 74,000 units in stock. And we pulled back, I want to say about 7,500, 8,000 units, somewhere in there during the free removals promotion. Most of it was just either leftover little bits from different seasonal candy, although we had to also pull back a lot of, not a lot, but chocolate on certain chocolate SKUs due to meltables and things like that. But yeah, I'd say 7 to 14 days is generally what I look at when things have been in there at least 3 months. We're trying right now to develop a little bit better system for it, but something I'm hoping to work on to improve. It's not something I'm strong at enough, I feel, at this point.
Yeah, my stuff is much lower turn, so it takes me a while longer to get a good sample size of data. And then I've sort of engineered things that allow me to be more loosey-goosey with my numbers, because I think my average profit per item is probably in the $19 to $22 range. And so that allows me to eat a lot of storage fees. It allows me to, I mean, I've done that to optimize factors in my favor as far as being a 1 or 2 man shop. Like I wanted to increase the amount of profit per labor and amount of profit per shipping, or reduce the amount of fees. Because if I'm shipping high dollar, low volume type items, then that tilts things in my favor as far as storage fees, as far as shipping, as far as labor, as far as even complaints. Like you could sell 10,000 pairs of $20 shoes, or you'd sell 1/5 of many as if the ASP is 100. So that would reduce your amount of turnover, reduce your amount of complaints. And so that's one thing that I've tried to focus just on very high ASP to reduce those factors. But at the same time, it allows me a longer timeline as far as turnover, but then I'm not on top of the numbers every 2 weeks.
So quick follow-up. Would you rather cut the price $3, or would you rather eat a $3 storage fee?
Depends on, once again, what the item is. If I think that it's, let's say you're sent in soccer shoes in January, or actually it's not a great example. Sent in soccer shoes at the end of season, so like August, September, and they didn't sell all winter, but you got a storage fee, say in February, but you thought they might sell in March or April since kids are starting to play soccer again, I would probably take the $3 storage fee. It's a little bit of a gamble. Now, if I had 100 chocolate bars, and I know I'm not going to sell more than 10 in the next couple of months, and they just overbought and screwed up, I'd rather take the item back and just scrap it out and donate it to a food bank, or I would take the loss on a sale. But generally, when it gets to be more than what the removal fee would be, and since my cost of goods on food, it's on an average item is like anywhere between less than $1 and $2.50, it makes more sense to pull it back. But once again, it sort of depends on your average selling price, your business model, and a whole lot of other factors. It's not really a one-size-fits-all answer, but
I think there's a lot of factors that go into answering the question. One being, how deep are you in that product or ASIN? Another being, it seems like it's easy to go down, but it's much harder to go up in price. And then another complicating factor is avoiding a $3 storage fee would, I guess reducing the price $3 doesn't impact your bottom line by $3 because of Amazon's cut. So your net might only go down to $220 or $250 with that price reduction because of what Amazon's taking out. So I'm greedy, and so I would tend to hold high and wait everyone out. But like I said, it's built in with the profit margins that I can absorb several storage fees. And I guess another thing that people don't take into consideration when looking at the return on equity. I mean, let's say you started this business day one with $100,000 cash. You can put however much of that you want into inventory. You can also put however much of that you want into your warehouse or your vehicles. But the thing is, your warehouse, your vehicles, they help you, but they're not compounding the same rate that your inventory is. Let's say, like, if you, of that $100,000 starting capital, if you put $50,000 into a warehouse, congratulations, you're in the real estate business now. And the real estate business, long term, tends to go up at about inflation rates. So for me, I don't like to own a lot of things if I don't have to.
Hi. As a new seller I want to start putting my books together, but I'm not a numbers person. So would you recommend double entry or single entry?
You want a double entry accounting system, and here's why. And I'm going to say this to Inventory Lab. Hi, over there. Inventory Lab is a great system, but they also say in their help files they're working probably towards it, but they're not yet something like QuickBooks where they're a true accounting system. They do a great job of telling you what your inventory is worth. They do a great job at telling you, individual sales and how those numbers work out. Having a double entry bookkeeping system is the reason why I tell people to do it from the start is most banks, most investors, most insurance companies, a lot of different vendors that you will work with as you continue to grow, and you want to continue to grow when you're new, but it's one of those things where you're like, I want to try and make it as easy as possible on myself too, because you're new. But if you set yourself up for success early on, it makes all the difference. Let's just say that when my first year selling, we didn't really use any accounting system, and that was really interesting. We went up to about $400,000 in sales. Second year, we jumped to 1.1 million, so about 300% growth again. That year, we used QuickBooks, and I was doing it myself, and I did a great job of reconciling all the credit cards, but I screwed up everything else from the bank statement side, and it took hours with the accountant to figure it out. So there are many great companies that can show you. QuickBooks even has their own free training. It's pretty good. It's not 110% amazing, but it's pretty good and can get you started. But yeah, a double entry accounting system is going to save you a lot of time and a lot of headache, because even if you when I was getting my insurance quoted again, they required double entry profit and loss and a financial statement. The bank required, when we closed on this loan this last week, a profit and loss, financial statements, balance sheet. It's just something that's expected, unfortunately. But it doesn't have to be that hard.
To add on, you should definitely get in the best practices early on, because especially in this business, if you work hard, things can take off like a rocket ship. And for me, I didn't do things the right way, and so after my first year in business, I had to go through and backfill about 10 to 15,000 entries as far as what their costs were. I mean, so it's not sexy learning the accounting and the software, because you just want to find product. But what is sexy is knowing where you stand and having the confidence to buy, because otherwise you're just seeing a lot of cash go in and out, and maybe some of it's profit and maybe it's not. But if you do it properly, then you know your numbers, then that will give you the confidence to continue to just sprint, as opposed to being very hesitant and cautious.
Let me give you one more thing as a new seller. This is something I wish I had done earlier on. Everybody is going to not everybody, many people will tell you to not pay yourself, don't take any money out of the business. By all means, don't go buy a $200,000 house with all the money you make from Amazon the first year you're selling. Number one, that would be incredibly fantastic if you could get $200,000 in cash after taxes. But number two, the bigger thing is don't go 2-3 years into your business without paying yourself something. You know, because a lot of people get burnt out. They're like, oh, I see all this money coming in. I'm making all this money, but I don't know where it's going. You know, my accountant said I made 180 grand last year. I don't know where that is. I don't have that in my bank account. You know, it's why I say doing the right things early on, the double entry accounting system, within your first couple months or once you hit about $10,000, $20,000 in sales, getting business insurance. It doesn't have to be expensive. It doesn't have to be super fancy. A lot of these things are like probably $20 to $40 a month. You do have to watch them so you don't get like $320 a month bills from all these different things you sign up for. But they are important. And you want to set yourself up the right way so that way, if something were to happen, you don't have any problems.
Can you guys talk a little bit about how you manage debt and whether or not you use debt, whether that be credit card or bank loans or whatever else?
So we actually just closed on an SBA loan. So for those who don't know what that is, the Small Business Administration in the United States actually underwrites to a certain extent certain banks lending to small businesses. Generally, you have to have 2 years of tax returns to get one of these loans. There are some exceptions to that for amounts under $50,000, but you have to go talk to a participating bank. You can basically Google Small Business Administration and the nearest major town to you, and you can go talk to them about getting a loan or talk to a participating bank. We just closed on a little bit over a $500,000 loan once everything's all said and done from them. It's to help finance a lot of our money going into Q4, because we're going to be purchasing some very large orders from different vendors. We're also currently upfitting our warehouse because we're moving warehouses in the next 2 weeks, hopefully, if it doesn't flood again. Yay. But debt's very important. You need to realize what you're paying for your money. And that doesn't just mean interest. That means opportunity of what you can get out of that debt. You know, if you're paying 7% for something, but you're only returning 3% on what you're selling, it's not really worth it. Debt. I do use credit cards, but they're all paid off in full every month. We don't pay credit card interest. Credit card interest, unless you're lucky, is like 18 to 25% typically. I'll let Dang.
I would recommend looking at the after-tax cost of debt, because debt is a the interest is a business expense. So even though you're paying 7%, after tax it might be 4 or 5%. So it's not as bad. And especially most debt is going to pale in comparison to the rates of return that you can get on inventory. So if you can, I guess the line of credit was what I would advise if you can get it. It's just as far as being the most flexible and the cheapest debt that you can find.
This question's for Dong. So, just want to know, where can I get a cool headband like that?
You have to enter the All Valley Karate Tournament. I didn't know I'd be speaking until this morning, so.
I think he can do a backflip. I'm not really sure. Oh, he tries.
I was just curious how many people in the room ever take advantage of the Amazon loans that they offer.
Yeah, Amazon lending. How many people have ever had an Amazon loan? I have. I just paid them off yesterday. It was a great feeling. Out of curiosity, what interest rate were they offering you? Do you remember?
Well, we just We took one when we very first started. It was
Okay.
just like a $4,000 one or something, and we paid it back in 6 months.
10's actually pretty good
Yeah.
from
I
Amazon.
think it was actually
Their most
that
recent
one.
offer to me was, well, actually last month they offered $750,000, but it was at 14.9%.
Yeah,
Um,
that's what it was. It was 14.9.
Yeah.
That's what it was.
Yeah.
We-
Ultimately, if you can get out, avoid Amazon.
Yeah.
That sounds bad. Amazon lending is a great tool when you're in your first couple of years of business, or if you really can't get money else because, let's say, you have maybe some credit issues or what have you. Other than that, try and avoid them. Yeah, I think we got time for EJW.
Okay, so aside from revenue and profit, what are your top 3 numbers that every seller should know regardless of business model?
Top 3 outside of revenue and profit, fixes. Ongoing subscriptions is huge. And I would also say your average inventory turn. So the nice thing about most of those numbers is they're pretty easy to find. Average inventory turn, Amazon calculates for you. Sometimes it's not quite right, but they do a enough generalized job that I would let you use that number. You can generate it yourself, but if you know how many turns you're doing a year, if you're only turning your inventory 3 times a year and you're selling groceries, that's a problem. If you're turning your inventory 4 times a year and you're selling shoes, you might be doing very well. That number's relative to your business model, but if you see it going that you're doing less and less turns of your inventory as the year goes on, that might be meaning you have way too much inventory that's not selling.
I would stress looking at balance sheets more often. I think it's easy to just focus on sales and profit, but your balance sheet will tell you how efficiently you're operating and also how robust your business is. It's like suspension doesn't have to be a disaster. If you are robust enough, you'd be like, okay, I got X number of months of bills, and so if I get suspended, it's not the end of the world, as opposed to me being leveraged up to my neck. Like there's a difference between $1 million in sales where you might be leveraged 2 to 3 to 1 versus $1 million sales free and clear. And so, because that's the one thing too that I worry about is that we've all been, for most people's Amazon careers, it's been the salad of American commerce. Been 10 years since the last big recession. So we're a bit overdue for one. Not to be like a doom and gloom type person, but slowdowns do happen in business, and you don't want that small hiccup to totally ruin years worth of work. So having a robust balance sheet as far as not being too leveraged. Like the one thing that I hate about the Amazon loan is the structure of payments. It's like you get a huge lump, and then it might take you 2 weeks, 4 weeks, 6 weeks to deploy all that capital, but then you start paying it back immediately. So you don't really have full use of that capital as you'd like. So,
How many months of fixed expenses should you have socked away?
Travis is telling me to cut it, but I would say 3 at minimum.
yeah, it depends. I guess it also depends on the type of product you're sourcing and the risk that it presents, and also sourcing type, category type, RA versus wholesale, and then I would moderate accordingly.
Well, thank
Cool.
you guys.
Thank you. Wait, one more thing.
Oh, hold on.
Before. Come on.
Are we going to do this?
Come on, let's do it.
Oh, God.
Had to. All right, thanks, guys. Give it up
Thank
for
you, guys.
Filling in last minute. Appreciate you guys.